Have you ever wondered how the really great businesses create value that lasts? I'm not talking about luck, and I'm definitely not talking about hype. It actually comes down to four fundamental levers. Today, we're going to break down exactly what they are and, how they actually work. Okay, so first things first, we have to tackle this huge distinction that trips up so many leaders, and that's the difference between enhancing a company's stock price and enhancing its real intrinsic value. Believe me, they are not the same thing, and confusing them is just a recipe for disaster.
So think about it like this. On one side, you've got price enhancement. That's all about chasing market sentiment. It's kind of like trying to catch a wave. Sure, it's thrilling, but you don't control the ocean. But then, on the other side, you have value enhancement, and that's about building a better surfboard. It's a long-term strategy, right? It's focused on the fundamentals that are going to help you ride pretty much any wave the market throws at you.
I mean, just look at the dot-com boom for a perfect example of this. In the late 90s, companies that literally just added .com to their name saw their stock prices explode, sometimes by over 100%, without actually changing their business at all. But get this, just a few years later, after the bust, companies saw their prices jump again, this time for removing .com from their names. It's just a wild example of how fickle the market can be.
So the takeaway here is really simple. If your only job is to boost the stock price, you've completely given up control. You're just dancing to the market's tune, and that tune can change in a heartbeat. The real game, the smart game, is building fundamental value.
All right, so how do we actually build that real value? We've talked about the trap. Now we're going to get into the four levers of value creation. We'll break them down one by one, and then we'll see how it all works with a real-world case study.
Let's get to the core framework. You see, these four levers, they're really the only pathways to boosting a company's true value. Seriously, every single smart business move you can think of, every action that creates value, has to flow through one of these channels.
So here they are. First, you can increase cash flows from what you already have. That's all about efficiency. Second, you can increase the value you get from growth, making sure you're growing smarter, not just bigger. Third, you can reduce risk, which makes your future earnings way more certain and therefore more valuable. And finally, number 4, you can extend your high growth period, basically building a competitive moat so you can keep growing for longer than anyone else. All right, let's dive into that first lever, boosting cash flow. This one is all about operational excellence. It's not about inventing the next big thing. It's about running the current business as well as it can possibly be run, squeezing every last drop of value out of what you already have.
And there are 3 really direct ways to do this. 1, you can cut wasteful costs, which gives you higher margins on the exact same revenue. 2, you can legally minimize the taxes you pay, keeping more of the money you make. And 3, you can find clever ways to spend less just to maintain your existing assets. It's pretty straightforward, right? More cash flow means more value.
Okay, on to our second lever, growing smarter. Now this one is huge because so many companies fall into this trap of just pursuing growth for growth's sake. And that can actually destroy value if it's not the right kind of growth. And this right here is the golden rule. You only create value when the return you get on your investments is greater than what that capital cost you in the first place. I mean, think about it. If you're spending $1 just to get 80 cents back, you can literally grow yourself right into bankruptcy. So which growth strategies actually work the best? Well, some really great research from McKinsey gives us a super clear ranking. And by a long shot, the absolute best strategy for creating value is developing new products. The classic example, of course, is Apple with the iPhone.
And digging into that a bit more, right after new products, expanding into new markets is also a fantastic strategy. But look down at the bottom too. Trying to fight for market share in a stable market? That usually just leads to price wars that destroy value for everyone. And historically, the most difficult path, the one that is most likely to fail, is growing through acquisitions, mainly because you often have to pay such a huge premium.
All right, now for our last 2 levers, which are really all about durability. They kind of work together to build a business that can truly last. How? By reducing risk and by extending its competitive advantage period.
So lever number 3 is all about extending that high growth period, and you do that by building a strong competitive moat. Think of Coca-Cola's brand name, or a pharmaceutical company's patent on a drug, or think about the high switching costs that keep you locked into your phone's operating system. These advantages protect the business and let it out-earn its rivals for way, way longer.
And lever number 4 is about reducing risk. In the world of finance, less risk simply means your future earnings are considered more valuable today. You can pull this off with smart financial moves like optimizing your debt, or you can do it operationally by, say, reducing your fixed costs or by making your products so essential that demand is predictable even when the economy gets rocky.
So that's all the theory. But what does this actually look like in the real world?
Let's try and put it all together with a quick case study of the software giant SAP.
So at the time of this analysis, SAP was a super healthy company, but it had a couple of blind spots. First, it hated debt. It used almost none of it. And second, it was a little timid about reinvesting for growth. Under that status quo, the valuation was about 16 euros per share. But by just applying two of our levers, optimizing the debt ratio to 30%, which is lever 4, and increasing reinvestment for growth, lever 2, the potential value jumped all the way to 26 euros per share.
That's what this framework can do. I mean, just two strategic changes pointed to a potential 62.5% increase in the company's intrinsic value. This is the incredible power of focusing on real value creation, not just what the stock price is doing on any given day.
And you know, what this all really proves is that creating value isn't just something that happens in the C-suite or the finance department. No, it happens in the marketing department, on the shop floor, in every single decision made all across the company. It's truly everyone's responsibility.
And that really just leaves us with a final thought to take away. As you look at these four levers, boosting cash flow, growing smarter, extending your advantages, and reducing risk, which one do you think holds the most untapped potential in your own organization? Thanks so much for joining me.